Hello students, welcome to Accounting Explained at AccountWise Academy. This is Latha Venkateshwaran. Today's session is on the break-even point and margin of safety. Before we begin, please watch my previous videos on contribution and P by V ratio as they provide the foundation for understanding today's topic. I'll be sharing the link in the description box. Break-even point is the sales level where your total revenue or total income will be equal to the total cost. And at this point, there will be no profit or no loss. That is zero profit. We are going to explore now why break-even point is so crucial for business planning. Why break-even point is so important. Break-even point tells you the minimum sales volume to avoid losses. It guides pricing, financial planning, and helps to set realistic sales goals or targets. Hence, it makes itself an indispensable tool for decision making in the business. To calculate the break-even point, we have to understand these components. First is fixed cost. These costs remain constant regardless of your output, like rent, salaries, etc. They do not change according to the production volume, right? Fixed rent, if you're going to pay, you're going to pay the same amount every month. Similarly, salary is also not going to change every month. You're going to get the same salary. That is why they are called fixed cost. Next, variable cost. From the name itself, we can know what is the meaning of variable cost. These are the costs that are going to fluctuate with production or with the volume of production. Examples are materials, labor, etc. Next, most important thing you have to know is selling price per unit. Okay. Next, you have to know contribution margin. Contribution margin is selling price per unit minus variable cost per unit. Okay, all these things I have discussed in detail in my previous videos on contribution and P by V ratio. There are two videos on that topic. You have to be thorough with that before coming to break-even point analysis. Okay, so please watch those videos for a better understanding. Let's now learn the break-even point formula. Break-even point in units is equal to fixed cost divided by selling price per unit minus variable cost per unit. This selling price per unit minus variable cost per unit is the contribution per unit. So you can also write the formula as fixed cost divided by contribution per unit. This formula helps you find the exact number of units you need to sell to cover all the costs. So this is the point where there is zero profit or no loss. Beyond this point, you are going to earn profit, and below this point, there will be loss. This is in units, okay, volume. Let us solve a question to understand how to find break-even point. The question is as follows. A company has the following data. Fixed cost is 50,000 per month. Selling price per unit is 500. Variable cost per unit is 300. Calculate contribution margin per unit. Break-even point in units. So first let us find out the contribution margin. Contribution margin formula is selling price per unit minus variable cost per unit. Here selling price is 500. Variable cost per unit is 300 minus 300. So you get contribution margin as rupees 200. Next, break-even point in units. Fixed cost divided by contribution margin is the formula. So fixed cost in the question is 50,000 divided by contribution margin. Just we calculated it as 200. So 50,000 divided by 200 is 250 units is your break-even point. With the same selling price per unit, variable cost per unit, and fixed cost with the same amount, if you are going to produce more than 250 units, you are going to earn profit. If you are going to produce less than 250 units, then you are going to incur loss. And at the point of 250 units, there will be zero profit. What is margin of safety? Formula is actual sales minus break-even sales. Margin of safety measures how much sales can fall before the business incurs a loss. So if actual sales is lesser than break-even sales, then it is a loss. So always actual sales should be greater than break-even sales to earn profit. Margin of safety helps in to calculate that. It also provides a safety buffer before losses. and indicates the risk level in your operations. Importance of margin of safety. Larger margin, lower risk. The difference between actual sales and the break-even sales is margin of safety. If that difference is 1 lakh, that is larger margin, right? So we can say the business is at lower risk. Smaller margin, higher vulnerability. If the difference is only 1000 rupees or in negative, then it has higher risk. The business has higher risk because it is going towards losses. Therefore, break-even and margin of safety analysis help set sales targets, price products, assess new projects, and plan strategically. They are crucial tools for informed business decisions. Let's solve another question. Bright Tech Limited has fixed cost of rupees 2,40,000 per year, selling price rupees 6,000 per speaker, variable cost rupees 3,600 per speaker, expected sales is 120 speakers. We are asked to find out break-even point in units and margin of safety in units and percentage. Come on, students, let's solve the question together. So this is the question. Now let's go step by step. First step is to find out the contribution margin. Contribution margin formula is selling price per unit minus variable cost per unit. Selling price here it is 6,000 per speaker, 6,000 less variable cost per unit is 3,600 per speaker less 3,600. So we get contribution margin as 2,400 per speaker. Next step is to find out the break-even point in units. Formula is fixed cost divided by contribution margin per unit. Fixed cost is given in the question as 2,40,000 per year. So 2,40,000 divided by, we just calculated contribution margin as 2,400. So break-even point in units is 100 units. Next, margin of safety in units is actual sales minus break-even point sales. Here we have only expected sales in the question. So we take expected sales as the actual sales. 120 speakers is the expected sales. So take that as actual sales minus break-even sales is 100. So 20 units is the margin of safety. Then they have asked us to find out margin of safety as percentage. For that, the formula is margin of safety units divided by actual sales in units into 100. Again, I'm telling you, expected sales given in the question is the actual sales we have to take like that. So, margin of safety we just calculated as 20 units. 20 divided by 120 is the actual sales. The whole thing multiplied by 100. You get margin of safety as percentage as 16.67 percentage. This is how you have to do the question or solve the question. Let's see the uses of break-even point and margin of safety in the business. They help to set sales and profit targets, price products strategically, assess new product viability, and plan strategically and manage risk. Though break-even analysis has many advantages, there are some limitations to break-even analysis also. They assume fixed cost and prices remain constant. So the selling price, variable cost and the fixed cost remains constant. With that only we can find out break even point and margin of safety. So that's a major disadvantage of break even analysis. There are chances that costs or prices may vary over time. That's right, no? Costs or prices can vary according to the market situations or according to the supply demand situation or according to the consumer taste, etc. So regular updates are needed to keep break even analysis viable for the business. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.